There's a moment that happens in leasing offices and loan departments every single day. You're 41, you're refinancing, or co-signing for your kid, or applying for an apartment after a divorce, and somewhere in the paperwork, a decision you made 9 years ago surfaces. A card you closed, a payment you missed during a bad month you've mostly forgotten. You have changed since then. The record has not. And here is the paradox this entire episode is built on. The credit system is the only institution in your life that formally promises to forget you 7 years, the law says, and it's gone while being engineered, from its very first day of operation, to never forget anything. Both of those things cannot be true at the same time. I'm going to show you which one is the lie, where it came from, and who has been collecting on it since 1899. Let's start with what you believe, because it's a reasonable belief, and you were given it deliberately. You believe your credit history is a record. Neutral, mutual, a ledger that protects both sides of every transaction. Lenders can't know you personally, so the file speaks for you. It proves you pay what you owe, and it protects you from being judged on rumor, on appearance, on the whims of whoever sits behind the desk. Before this system existed, credit was granted on reputation and relationships, which meant it was granted on prejudice and proximity. The file replaced all of that with math. That's the story, and the story comes with a second promise, the one that makes the whole arrangement feel fair. The record forgives. Mistakes age off. Under federal law, most negative information falls away after 7 years. Bankruptcy, the heaviest mark you can carry, disappears after 10. The system doesn't just track you, it grants you a statute of limitations on your own past. Do the work, wait it out, and you get a clean page. Your 20s can't follow you into your 40s. The bad year after the layoff, the medical bill that spiraled, the divorce that shredded 2 households' finances, all of it has an expiration date printed on it. So the arrangement feels like a contract between you and the system. You behave consistently. The file testifies on your behalf, and the file's memory is finite. It watches, but it also forgets. That combination, precision plus mercy, is what makes the whole thing feel legitimate. It's why you've never seriously questioned who holds the file, or why it exists, or what it actually is. A fair record that expires doesn't need questioning. Hold that belief for a moment. Now let's put one crack in it. The crack is small, and it sits in the fine print of the same law that made you the 7-year promise. The Fair Credit Reporting Act, the 1970 statute that governs this entire system, does set time limits on negative information. 7 years for most of it, 10 for bankruptcy. But the statute then lists the situations where those limits simply do not apply. If your credit report is being used in connection with a job that pays more than $75,000 a year, the time limits don't apply. If it's being used for an application involving more than $150,000 of credit or life insurance, the time limits don't apply. Read that again. The expiration date you were promised has income thresholds. The forgetting is means-tested, and it's calibrated to stop working at exactly the moments that matter most in an adult financial life. A senior job, a mortgage-sized loan, a life insurance policy that actually covers a family. And there's a second detail, quieter than the first. The consumer protection agencies that explain these rules use very careful language. They say credit reporting companies generally won't report negative information after the limits, but they may still keep your information on file. Keep on file. The 7-year rule governs what can be displayed on the report a lender pulls. It says nothing about what can be retained. Deletion was never part of the promise. What you were sold as forgetting is functionally a display setting. One more thing, and then we go looking for the mechanism. Paying off a debt does not remove it. A collection you settled in full stays on the report for its full term. Marked paid, still visible, still scored. The record does not respond to repair. It responds to time and only on the surface, and only below certain dollar amounts. So the belief was a fair record that expires. The reality, so far, a record that expires selectively on the display layer only, held by someone who was never obligated to erase anything. Which raises the real question: who holds it, and what is it actually to them? The mechanism has a name: Behavioral surveillance design, not surveillance in the cinematic sense. No one is watching you in real time. Something more patient than that. A system built to convert your financial decisions into permanent records, and those records into a sellable asset, owned by someone who is not you. To see it clearly, you have to go back to where it started, because the origin tells you what the machine was actually built to do. Atlanta, 1899. Two brothers, Cater and Guy Wolford, rent a single office room and print the words Retail Credit Company on the door. Their product is a book. They go through the ledgers of local grocers, copy out which customers pay their tabs and which don't, compile the results, and sell the book to merchants. Notice what just happened, because it's the entire industry in miniature. The information was about the customers. It was generated by the customers. The customers never consented to its collection, were never paid for it, and could not inspect it. And the money flowed between two other parties entirely, the compiler and the merchant. From day one, the person in the file was not the customer of the file. The person in the file was the product. The company grew, and as it grew, its appetite told you everything about the design. Within a few years, it moved into insurance reporting, what the industry politely called moral hazard assessment. Its investigators didn't just record whether you paid your bills. According to the critics who eventually dragged the industry in front of Congress, the files came to include facts, rumors, and inaccuracies about nearly every phase of a person's life: marriages, employment history, schooling, drinking habits, even sex lives and political activity. One of the most prominent of those critics, a Columbia professor named Alan Weston, made the point that matters most for this episode. Once files like these are computerized, it becomes harder and harder for a person to escape the mistakes of their past or to move somewhere new in search of a second chance. He wrote that in 1970. It was the permanence, not the snooping, that alarmed the people who understood the system best. There were also allegations that the company rewarded employees for the volume of negative information they collected, because negative information was the differentiated product. Anyone can tell a lender you paid on time. The asset was your failures. Congress responded with the Fair Credit Reporting Act in 1970. And here is where the paradox at the center of this episode was manufactured. The law gave you the right to see your file, the right to dispute errors, and it created the time limits, the 7-year rule you've been living with your whole adult life. What the law did not do is change who owns the file. It didn't require your consent to build one. It didn't give you the right to leave the system. It regulated the display of the asset. It left the asset itself, its collection, its retention, its sale fully intact. The company that had spent 70 years compiling files on people's sex lives and political opinions absorbed the new rules, paid some fines for violating them, changed its name by the end of the decade to something cleaner and more clinical, Equifax, and kept operating. The rename cost them a reputation. The regulation cost them a display format. The business model didn't move an inch. Then, in 1989, the machine got its final component. A company called Fair Isaac introduced the FICO score, a method for compressing an entire credit file into a single 3-digit number. This is usually told as a consumer-friendly story: standardization, objectivity, speed. But look at what it did to the time dimension of the file. Before scoring, an old record was a line item a human underwriter might weigh, discount, or ignore. After scoring, every record in the file, including the aging ones, feeds a single number that follows you into every application, every rate, every approval, continuously, in real time. The 7-year rule tells you when a line item stops being displayed. The score is how the file's memory gets operationalized every single day until then. Your 2019 stumble isn't sitting in a drawer waiting to expire. It is actively repricing your present, this month's insurance premium, this year's refinance offer, right up until the moment it ages off. And your positive history? That can be reported indefinitely. Permanence, when it works against the Bureau's framing, is called a burden. Permanence, when it keeps you legible and scorable forever, is called your reward. So assemble the mechanism. A file you didn't ask for, built from data furnished by every lender you've ever touched. retention with no deletion obligation, display limits with income exceptions, a scoring layer that converts the stored past to a live price on your present, and a business model in which the Bureau's actual customers, lenders, insurers, landlords, employers pay for access to you. That is behavioral surveillance design. And before we watch it land on one household, hold on to a question we'll come back to at the very end. If the file records everything you do with borrowed money, what does it record about the people who don't need to borrow at all? Let me show you what this looks like when it surfaces in a life. What follows is a composite and illustrative construction built from aggregate consumer data and documented reporting rules, not a real individual. But the mechanics are real, and the moment is one that versions of him live through constantly. Start at the moment of understanding and work backward. Daniel is 47, married, 2 kids, a household income of $126,000 a year. In the spring of 2024, he's sitting across from an insurance broker, applying for a $500,000 term life policy, and the broker mentions, almost in passing, that for policies of this size, the usual credit reporting time limits don't apply. The underwriter's file can legally reach back further than the report Daniel is used to seeing. Daniel asks him to repeat that. Then he goes home and reads the statute himself and finds the threshold sitting right there in Section 605. Jobs above $75,000, credit and life insurance above $150,000. Whether any bureau would actually furnish the old data in his particular case is a separate question. That's not what unsettles him. What unsettles him is the discovery that the expiration he had organized 11 years of quiet effort around was never a deletion, only a promise about display, and a conditional one. The feeling he can't shake for the rest of that week has a specific texture. Call it quiet vertigo. The floor didn't collapse. He just found out it was never attached to anything. Now trace it back, because the vertigo has a starting point. Rewind to 2021. That's the year a certain line item aged off his consumer credit report, right on schedule, and Daniel felt something he didn't say out loud: relief. A page had turned. He'd waited for it the way you wait for a sentence to end. Rewind further, 2015. Daniel pays off a collection account in full, $2,140, and learns his first hard lesson about the file. Paying it changed its label, not its lifespan. Paid collection. Still visible, still scored. He remembers the specific indignity of that. He had done the responsible thing, and the record's only concession was an adjective. Rewind to the origin. March 2013. His wife is sick that year. The bill that eventually becomes the collection is a medical bill, $2,140, from a string of specialist visits lost in a pile of paperwork during the worst months, unpaid, not out of refusal but out of triage. By the time it surfaces, it has already been charged off and sold. One administrative oversight during the single most stressful year of his adult life becomes a data point. The data point becomes an asset. The asset gets sold into a system that will price his family's borrowing for the better part of a decade and, he now knows, retain the memory of it beyond that. Here's what the reverse trace shows that the forward version hides. Lived forward, Daniel's story feels like progress, crisis, payment, patience, expiration. Every step rewarded. Lived backward from the broker's office, it reads differently. A system that took 11 years of his compliance, and at the exact moment the stakes got high enough, a policy large enough to actually protect his family reserved the right to reach past its own promise. Daniel does not stop the life insurance application. He doesn't rage, and nothing dramatic happens. He signs the forms. But something in his relationship to the system has permanently shifted, and it doesn't resolve. He had believed he was building a clean record. He understands now that he was never the one holding the eraser. Now pull the camera back. Because Daniel's file is one of hundreds of millions, and the scale is where the design stops being abstract. Equifax alone reports collecting and aggregating information on more than 800 million individual consumers worldwide. Add Experian and TransUnion, and the three bureaus hold behavioral files on essentially every credit-active adult in America. Files no one in those files are signed up for, and no one in those files can close. There is no unsubscribe. You can freeze access to your report. You cannot make the record stop existing. Try to name another private commercial relationship in your life with that property. Mandatory enrollment, permanent retention, no exit. And the file has quietly escaped its original habitat. It was built to answer one question: will this person repay a loan? And it now gets consulted for questions that have nothing to do with lending. Landlords screen tenants through it. Insurers in most states feed credit-based scores into premium pricing. Employers, with your consent, the kind of consent you give when refusing means not getting the job, can pull a version of it before hiring you. Each new use case is a new revenue stream for the bureaus, and each one raises the price of the same old data points, a hypothetical labeled as such. Imagine two equally qualified applicants for the same apartment. Identical incomes, identical jobs. One carries a 2019 collection from a medical crisis. In the lending context, that mark supposedly measures repayment risk. In the rental context, it functions as something else entirely: a character reference written by a machine, submitted without the applicant's participation, unanswerable in the moment it matters. Then there's 2017, the year the design revealed its own valuation. Equifax announced a breach in which cybercriminals accessed the personal data of roughly 145 million American consumers' names, social security numbers, birth dates, addresses. Sit with the number for a second. Files on nearly half the country, so valuable that stealing them was worth a sophisticated criminal operation. Now watch what happened next, because this is the part that exposes the structure. The company paid a settlement in the neighborhood of $650 million. Individual consumers, after the class action math resolved, were looking at payouts of a few dollars each. And Equifax kept operating, kept growing, and today generates billions in annual revenue. A catastrophic failure of custody, the kind that would end a company whose customers could walk, ended nothing. Because the people in the files were never the customers. You cannot take your business elsewhere when you were never the business. You were the inventory, and inventory doesn't churn. That is what permanence looks like at scale. A national behavioral archive, compulsory, portable across industries, monetized on every query, and structurally indifferent to the people it describes because their opinion of it has no revenue consequence at all. So let's go back to the phrase you walked in with and take it apart, because the phrase itself is doing work on you. Credit history, 2 words, and both of them are misdirection. Start with history. History is a record of the past, and the past by definition is finished. But nothing in this file behaves like the past. Every entry in it is active, feeding a score that reprices your present in real time every month. In every application you submit, the file is in a history. It's a live instrument that happens to be denominated in old decisions. Time in this system doesn't heal, it amortizes. Your 2013 becomes a small recurring charge against your 2020, your 2022, your 2024, extracted not in payments but in basis points, premiums, and denials, until the display window closes and, above certain thresholds, even after. Now the first word, credit history, implies possession, your history, the story of you, but run the ownership test. You didn't create the file. You can't delete the file. You can't take the file with you, sell it, license it, or deny access to it in any complete way. Someone else compiled it, someone else retains it, someone else prices it, and someone else collects revenue on it thousands of times over its lifetime. In every sense that matters commercially, the file isn't yours. It's theirs, an asset on the books of 3 corporations, generated by your behavior the way a field generates a harvest. The paradox from the top of this episode resolves cleanly once you see this. The system promises forgetting to you and sells remembering to everyone else, and both halves of that sentence are true, because the promise and the product were never aimed at the same audience. The 7-year rule is real as a display regulation. The permanence is also real as a business model. You were shown the regulation and sold the story. The asset was never on your side of the table. which is why the honest name for what you have isn't a credit history at all. It's a behavioral record with your name on it and someone else's ownership stamp, the longest-running data business in America, operating continuously since two brothers copied grocers' ledgers into a book in 1899 and discovered that a person's past, properly stored, never stops producing income. Not for the person. The person just lives here inside a record he keeps being told is his, priced by a number he never sees, calculated on terms that expire for him and endure for everyone he'll ever apply to. If you can't walk away, you're not free. Here's a question to sit with in the comments and be honest with yourself. What's the oldest financial decision that's still following you? And when was the last time anyone let you explain it? One more thing before you go. Permanent behavioral records are a recent invention with very old incentives behind them. But notice what this entire system runs on: activity. Borrowing, spending, applying the file only sees you when you move, which means the people with the most money generate the least record. What does wealth look like when it stops making noise? That's the next episode.